As you're going through your M&A process, you may be thinking, what are the key controls, key checks and balances I should be paying attention to so that I pass SOX easily? Hi everyone, this is Kim Lay with A2Q2, your SOX strategist, evangelist, champion, advisor, and catalyst. In this video, I'll share with you the top key controls that are very typical of most M&A transactions. So there are between 6 to 10, maybe more controls, but the succinct ones we're going to review right here. And some of them are more key than others, so keep in mind this needs to be tailored for your organization and the type of transaction that you're doing, whether you're buying assets, whether you're buying intellectual property and technology itself versus an acquisition hire for talent. So the typical step here is number 1 is mergers and acquisitions are reviewed and approved by a CEO, the preliminary approval, CEO, CFO, before it gets to a board level. Some companies, depending on the approval authority, you may not need a board approval if it's a smaller type of transaction. So that's why M&A 2, the control number 2, is that board approval, making sure that board has reviewed whatever that package is, or if the board has delegated that authority to another committee, it might be an M&A committee, a special committee, or to the CEO, CFO. Next is going to be accounting or finance, getting involved and making sure whatever it is that is being acquired, they have an idea. This is typically not key because the business will drive the need, but at least getting finance involved so that finance is aware and can help in making sure the correct accounting happens later on. Number 4 control is for acquisitions. When you're forecasting your operating plans, the assumptions that you make by your FP&A team, your corp dev team, your strategy team, those are very important to make sure that the assumptions have been reviewed, the way you've built the model, and there's been some type of rigorous debate or review around that. Because that information is then used by your valuation experts to build out the value of your acquisition. And so the key input is going to be to your valuation team. Now your third-party valuation, once they complete it and they give that report back, it's going to be on the company, whether it's the technical accounting director or the controller or the assistant controller, to review the valuation, make sure the assumptions are consistent with what you've provided. The peer companies, if there are any assumptions made there, that it's the right peer companies and the right discounting or the right models, whether it's a cash discounting or income statement of some sort is being used. Next is, once you have the valuation model, someone has to prepare the purchase price allocation workbook, and the workbook plus a memo that comes with it. The purchase price allocation, while it sounds very simple, can get very complex with different components, and making sure that whoever's doing the preparation, there's a different person doing the review, which is control number 6. Control number 7 is going to be if you need to consult with a tax expert or other experts and make sure that the assumptions, liabilities that you're taking on are properly reflected, or assets that you think you're taking on like loss carry forwards, you can actually utilize them or you cannot. And so whatever the tax experts are doing, internally the company needs to have someone be able to review it and make sure that you agree with their assumptions and agree with their conclusions and the logic of how they came up with it. And then the purchase accounting memo, once you have the purchase allocation, once you have all the expert opinions on how to treat this, writing it up into an accounting memo so that you outline the background, the assumptions, the prices paid, what is goodwill, what are actual assets to allocate to. That's your purchase accounting. And of course there's going to be the journal entry that comes out of this to record this asset onto your books. And then after you acquire this asset there's going to be annually, there's a formal review, but also on a quarterly basis, making sure that the goodwill or the intangibles that you've bought are still good, they're not impaired. And so this is typically a quarterly light monitoring, but definitely once a year, the accounting literature requires you to do a robust review of the goodwill that's resulting and that nothing is impaired from there. So these are the typical areas or the typical controls that we see in the M&A process. Thank you so much, and we'll see you in the next video.